Hi, everyone. My name is Erica Plemmons, and I'm a senior economist with Bright MLS. It's time for another housing market update webinar. I'm so happy that you're here. Thank you for joining. And to give you a brief overview of what we're going to cover today, we'll start with our economic picture, and then we'll dive into housing market statistics. I've been hearing your comments, and I know that a lot of you are hoping for local flavor. And while the focus of our housing market update webinar tends to be the Mid-Atlantic overall, I tried to sprinkle in some statistics focused on those metro areas so you get to know some of the nuances, the similarities and differences between the areas within the Bright footprint. Now, if you attended last month's webinar and received that follow-up email from Zoom, can you give me a quick thumbs up so that I know that that went through? I'm hoping you did. And if you're attending our webinar, you should receive a follow-up email from Zoom with a link to the recording of today's presentation, as well as the slide deck. So if you would have to hop off for whatever reason, know that you can access those materials. Now, I know my inbox can get full really quickly. So just in case, you miss that email, here's where you can find it on the Bright website. If you're on the public-facing version, the menu is going to be in your top right-hand corner. You're going to go to Research, and the submenu is called News and Insights. Once there, you'll see a list of content, and it is chronological with the most recent on top. And you can see the webinar, the housing market update. You'll go there and you can rewatch the recording or download the slides for your use. If you are logged in and you're doing your work, the same navigation will be just in your top left. So again, go to Research, News and Insights, and you can get that material. So while you know it's available, I hope you're going to stay on with me today. And as I said, we'll start with our economic picture. We're going to go through jobs, inflation, and mortgage rates. Now, employment is kind of throwing a curveball. Over the last several months, there had been a trend of significant slowing in those job gains. And that was likely good news for the Fed that is continuing to fight with inflation. But we can see that in September, there were 336,000 jobs added to the US economy. And those past months were revised upward, which is kind of counter to those downward revisions we had in the past. Now, this does not mean that, hiring is back to what we were seeing in 2021 and 2022, but it is something that, surprised many economists and those tracking these numbers. Some are wondering if this will play into the Fed's decision on rate hikes. But as we'll see in the next slide, there's another factor that we need to consider with the employment picture to understand how the Fed may make their move. Our bottom chart about the economy is the US unemployment rate. In September, it was the same as August at 3.8%. Now, prior to that, it had ranged from 3.4 to 3.7% from March of 2022. So it really hasn't been that different. I'm big and the charts are small. That is not what we want. Okay, let's see if I can stop my share and reshare and see if this helps. Thank you for your comments, though, because that helps me understand if we need to backtrack. Okay, so now that we've talked about this part of the economic picture, we're going to go forward and talk about within employment, what's happening to wages. The BLS data, which shows our job gains and the unemployment rate, reported that there was a 4.4 increase in wages for private sector employees in September. For comparison, in September of 2022, the year-over-year percentage change was 5.1%. So wage growth has eased. But in addition to, that wage growth that we're seeing, we want to know what's coming around the corner. And we can use the Indeed wage tracker to do that because they're looking at what employers are posting as the anticipated wages for positions. This chart in particular breaks it down by different price bands or wage bands, it would be. You have your low wage in blue, your middle wage in pink, and high wage in gold. Now, if we would smash these all together into an overall figure, in September, the growth was 4.4%, and the 3-month rolling average to kind of smooth it out was not much different at 4.3%. And you can see it differs by your tier, and they use the median wage in different geographies and occupations in order to establish those wage tiers. But the important thing that we want to know is no matter that tier, we can see that as they labeled this, wage growth is fading. It is not what it was in 2022. And even throughout this year, you can see that moderation. Yes, the slides are being shown, so hopefully you can see them on your screen. Our other topic that we want to consider, and wages play into this, is inflation. We're looking at the consumer price index, which the overall figure is in blue and our shelter component is in green. That shelter component has continued to trend downward, though it was up 7.1% in September. But it factors into 50% or over half actually of this overall CPI figure. So the overall number is still staying stubbornly high. In September, it was the same year-over-year change that we saw in August of 3.7%. Now, from August to September, there was a 0.4% increase month to month. And that's lower than the monthly jump we saw in August of 0.6%, but still we are knowing that the Fed is going to look at these inflation numbers and realize, hey, it's still above their target of 2%, and this could factor into their decisions. Knowing these employment and inflation trends, the financial market expectations are that the Fed will likely keep rates consistent at their November meeting, but they're pricing in maybe that rate increase in December. So the Fed will continue to monitor the data as it rolls in, and then hopefully make a decision based on what those numbers reveal. The other part of our economic picture, which directly impacts our housing market, is the mortgage rates. Mortgage rates since September have continued to head up, up, up. Last week, Freddie Mac reported that the average 30-year fixed mortgage rate was 7.57%. And you can see our latest figure, which was released today, is 7.63%. So even more than last week. Actually, rates, which I'm like, are they mirroring fashion or more resembling the 90s than they are what happened a few years ago? So we're going to have to consider how buyers are going to react to this. According to our subscriber survey, and it's important to note, our subscriber survey goes out to agents and brokers who have had a successful transaction. So these are buyers who have purchased a home. They are reporting that 50% of their buyers were going to buy regardless of the interest rates. So some buyers are still very persistent despite these high rates. Additionally, we have a group of buyers who are just completely avoiding that 7% plus rate, and they're doing so by paying in cash. Clearly, this is not an option for all buyers, but for some who may be able to, use prior home equity or other funds, this is a way that they can participate in today's market without having those high interest rates impact them. Excuse me. Again, though, this is successful transactions. We know through subscriber comments, anecdotal evidence, and just logic that today's mortgage rates make it so that some buyers have to move to the sidelines. And so we have a group of buyers who are pushing through and a group of buyers who are waiting until rates reduce. Now, for those buyers that are still chugging along, what type of housing market are they encountering? And will this fall bring some more inventory for those buyers who are still searching? As of the end of September, let me get that figure, it was 32,708 active listings across the Mid-Atlantic. And so our orange 2023 line has been lower than our gold 2022 line since June. And actually in September, it was 11.2% lower than it was the previous year. Now, putting this into perspective though, we were comparing 2022 and 2023. If we go back historically, though inventory, we're, kind of battling with, can we be higher than last year? In a historic context, inventory pales in comparison to what the pre-pandemic levels were in 2019 and 2018. But going back to our comparison of just the past 2 years, let's focus first on the Mid-Atlantic and recap. We've got that orange line, and where it crosses the 0 line, it's below it in June, July, August, September. And now you're seeing there's those gray lines. Those are our 9 metro areas. 3 of them are above 0%, which means they have more active listings at the end of September than they did last year. And that may be some welcome news. We'll focus first on the Del Mar coastal region. It has continually had more active listings than the prior year, though you can see the percentage difference has shrunk across time. The other 2 areas where there are more active listings now than the past, or I guess last year, is Maryland Eastern Shore and Central Pennsylvania. Though you can see there were periods of months where they were below where they were in 2022. So that means if you're in a metro area that is not one of these 3, your buyers are likely facing lower inventory than they did last year. And this will vary by geography and more local. So I'd encourage you to consider your county level data, zip code level, to understand a clear inventory picture so you can properly prepare both your sellers and your buyers for what's happening in today's market. Revisiting our historical perspective and doing it across our metros, we see that all metros except for Washington, D.C. have lower inventory, less than half of it in September 2023 than they did in September 2019. D.C. isn't faring much stronger at 54% of its inventory levels compared to September of 2019. So again, these are the considerations and obstacles that buyers are facing today with their choices. But in good news, inventory has grown since the summer. We're going to start with June in blue, and we can see our September in orange is always to the right. It's increasing no matter our metro area. Now, it's kind of hard to decipher some of those smaller areas like Maryland Eastern Shore, the Panhandle, or Southern Maryland, when the scale goes all the way up to 10,000 for areas like Philadelphia that have more inventory. So to capture the change that has occurred, we can see that for these metro areas, many of them have increased their inventory by about 10%. This is starting from a low base, but still it is a step in the right direction. Now, inventory is going to change, and we're going to wonder if those buyers stepping to the sidelines will play a part in kind of how it moves. But one thing to note is that even though some buyers are stepping to the sidelines, some buyers are continuing to hop right in. And actually, as of the September buyer survey, or I guess the October survey featuring September transactions, about 46% of those buyers just started looking in the past 2 months. So people are still joining the market and participating. And I think one of the things I at least take from this is that education is key. Realtors play an important part in educating their clients, and sitting down with someone and explaining how the rates have moved, how prices are trending, the inventory situation can help them understand what type of monthly payment they will be facing. And then they can make an educated choice of whether they can participate now or if they have to wait. And so, in a silver lining, for buyers that are continuing to chug along, those who move away mean that there are a smaller pool of buyers. And as we saw, there's more inventory than we've had in the summer. It continues to be the largest obstacle for buyers, though, to find that right home. But it has eased somewhat. From June to September, we see that those describing it as somewhat or very difficult went from 42.9% down to 39.5%. But even better, those describing this part as somewhat or very easy improved from 38.4% to 46.3%. And if we break our data down into just all 5 of the categories, it's clear those 2 blue lines representing very easy and somewhat easy have moved upward from June to September. The other thing indicating that maybe there's some relief for buyers in the market is the percentage of buyers who are purchasing with one offer. The submitting a successful offer tends to be that second highest obstacle that we're seeing in our survey. And as of September, there were 38.7% of those buyers who were able to make just that first single offer, excuse me, and win their home. This is an increase, as we can see from our summer numbers from June, but it's not quite what it was in early spring. Still, this is a trend we'll want to monitor as a sign of maybe an easier time for those who can handle these interest rates. There is a clear difference, though, between repeat buyers and first-time buyers. Our repeat buyers are that kind of yellow-orange line, and first-time home buyers are in blue. So the repeat buyers, 41.1% of them were able to purchase in September with just one offer, versus about a third, 33.3% of first-time buyers. Though, if we look at these lines, we can see increasing trends that more are able to purchase with just one offer in September than in June for any of the buyer types. Breaking it down to see kind of that range of offers, again, on the left, we have that comparison of only a single offer where repeat buyers, it's more likely to happen for them. On the other side of the chart, though, we see the blue bars are higher than the yellow-orange ones. And if we combine the 4 and the 5+ bars, what we get is about a third of first-time buyers have to make 4 or more offers. And this compares to 19.8% of repeat buyers. So again, there's that difference of maybe those who are coming with some equity and can make a stronger offer than first-time buyers. So we'll continue to kind of monitor the differences between these 2 groups, but know that both of them are, have a struggle with submitting successful offers as well as finding the right home, though conditions have improved since the summer. One of the things that will impact the conditions and impact our supply is the new listings coming onto our market. That orange 2023 line is significantly below where it was in prior years. When we look at those past years, and it's a little bit of a jumble, but what you can see with those other years is the seasonality in new listings. If we go from February, say through July, you see kind of this hump, this up and down. On the other hand, with our orange 2023, you can see that uptick in March, but new listings have actually been relatively stable throughout the year. So compared to typical seasonality, new listings have kind of been steady. If we focus on the two most recent years, 2022 in gold and 2023 in orange, we can see there's a distinct gap between those two time periods. It got as far apart as a 55% difference in April. And as of September, there were 30% fewer new listings in September of 2023 than the prior year. And that's because sellers need very strong motivations to list. They need to be incentivized. It has to most likely be a need instead of a want. And many sellers have low interest rates, and the math to trade to a 7% plus right now is not lining up. But new listings are only part of the puzzle of where supply will go. That's what's coming on. We also have to consider what's going off. And as of what will be moving off the market, we look at our new pending sales. Similar to new listings, our 2023 line is below what we saw in prior years. In September, you can see that it's below even where it was back in 2018. Focusing on our most recent years, this difference has at least shown a trend. And what we're seeing is that from March through July, there was clear, what's the word? There's clear shrinkage in the difference between the two time periods. And then there was that, uptick in August of a difference of 17.3%. But now in September, it's the lowest difference between the pending sales in those two time periods of 12.4%. So whether these lines will ever meet is really going to depend on, how motivated buyers are in face of these interest rates, as well as if there's inventory to accommodate the buyers that are still in the market. We want to compare, though, what's going on and what's coming off the market. And let's start with just this Mid-Atlantic with small chart. I'll throw in the metro areas just in a second. But recall, this green line is going to be new listings. Our blue line is our new pending sales. And I've tried to highlight the difference between the two in kind of this green faded shade, so you can clearly see the distinction of when new listings are higher than new pending sales. So now I'm going to pull in all the other metros. So go ahead, take a second, find yours. And if you are in one of those other counties, I'm going to try to start incorporating some county data into these presentations, so stay tuned. But we can see for the majority of metros, there is this green shading that's going on, that new listings are higher than new pending sales. On the other hand, the amount of green shading hasn't been so significant, and that means our inventory situation is remaining tight. Tight inventory means competition. And in September, the median sale price was $385,500. Okay, so it's rounded here. That is a 4.2% increase from last year. And you can see, other than April, which almost looks like it's overlapping, the median price has continued beating what it was in 2022. Now, it's important to note that the median is the halfway point. It can ebb and flow based on the homes that are on the market. So I'd encourage you to dig further when you're pricing a home, to use your comparable listings and get more granular data in order to advise sellers on what their home should be priced at for today's market based on their goals of selling. When we look at median prices across the Mid-Atlantic, the trend is very clear that no matter where you are, the median price increased in September. And there are some that show very strong increases for this month in particular. You can look at your county level median price growth in our monthly market reports, as well as look at your other county metrics, such as closed sales, pending sales, active listings, showings, and more. So with that, we're going to wrap up with a quick outlook. And who better to tell us what's going to happen than you? And so that's when we lean on our subscribers, you who are on the ground and working day to day with buyers and sellers. In our subscriber survey, we asked about the outlook. And what we are finding is that it is lower now than it was earlier this year. Part of the reason, of course, is due to seasonality in the real estate market. We asked for a 3-month outlook. So those who responded in April, they're thinking about May, June, July, our nice warm summer months. On the other hand, those who are responding currently are looking ahead to fall and winter. And we know typically sales are lower during that time than in the spring and summer. But I do want to note the uptick on that buyer outlook of low to very low that happened in September and October. And another part of that reason could be those up mortgage rates that are impacting buyer participation. Seller outlook, that right chart, has shown expectations for low to very low activity throughout the year, though it has increased modestly. So going ahead, we're expecting, slower fall and winter. And that's what we typically expect, but it could be almost slower than normal because of mortgage rates. Now, the other thing that is impacting buyers too is inventory. Finding the right home is difficult. So that is another reason for a slower fall and winter. Whether we kind of thaw as we approach spring will depend on a lot of our economic factors. One of the agents in the survey did kind of describe now's environment as frozen. So we're hoping that as we progress with the seasons and get more back to that spring buying season, that the market will shift. I hope that you found today's content valuable. I focus mostly on the statistics in our monthly reports as well as our subscriber survey, but we have plenty of resources available. There are weekly reports, there are blogs, there's our home demand index, and just recently Bright has released a number of studies. There was the On MLS study, and Bright also partnered with George Mason University to talk about the pandemic trends and how they're impacting the housing market long-term based on the government's reaction, as well as work from home. So I'd encourage you to go to brightmls.com/research to check all of that valuable content out. Dr. Lisa Cernovit is our chief economist. My name is Erica Plemmons, and we have a wonderful research analyst, Colby Stout. We are all here to help. Actually, I'm hoping that they'll be joining me for our next webinar, which is scheduled for Thursday, November 16th. So Thursday, November 16th at 3:15. So I hope I will see you all there. Unfortunately, we're running right up against time, so we're not going to be able to have questions today. But if you would, please fill out those post-webinar surveys. I do read your comments when I can and try to incorporate the type of information you're looking to receive. Thank you so much, and I hope you all have a good rest of your day.